Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today we're going to talk about an opportunity to get a 4.25% loan,
Yes.
which is pretty unheard of because today the average mortgage rate for 30-year fixed is 7.30%.
Right. So this is a 4.25% 30-year fixed loan. You heard it here. 4.25% 30-year fixed loan. Not only that, but it comes with a new house.
It comes with a new house. Mm-hmm. Okay, so we got this from
snow.
The reason why so this is from an article. We're going to talk about this, and then we're going to go into a little bit of detail about how this affects other loan programs and housing in general.
Right.
And because a lot of people have said, hey, there's no way out from this housing market.
Oh, that's nonsense.
And every time they say that, like three things happen that make, that counter that. Okay, here we go. Housing market affordability is so strained that this Fortune 500 home builder is offering a fixed 4.25% mortgage rate in some communities.
Right.
Okay, so let's first talk about this generic home builders offering whatever you call them, incentives. Is this a new thing that just happened because of affordability or whatever?
This is not a new thing. Home builders offer incentives all the time in certain markets. Full moon, even year, odd month, stepchild, whatever it is.
What are some of the incentives that they'll offer?
So they'll offer rate buy downs. They will offer upgrades. They'll offer closing costs. They'll offer a swimming pool. They'll offer landscaping. They'll offer window coverings, appliance packages, all kinds of things.
Okay. Fourth quarter of last year, KB Homes announced that they had like 30-something% fallout rate. And then immediately there was this plethora of people talking about, oh my God, there would be so many new homes coming on the market, it would crash the housing market. And it turned out that all those homes just went right back under contract with somebody else. And then the KB had record profits, right?
So apparently that 30% fallout was very profitable.
Okay, here's a first quote from the article. We're going to go into some detail. We have some very good numbers. Many of the best builder deals disappeared earlier this year as the U.S. housing market started to show signs of life amid the seasonally stronger spring and summer windows. So spring and summer for new home builders tend to be very strong for people writing contracts and going under contract in a house. Fall and winter, not so much. So last fall and winter, they had to offer a bunch of incentives. They either reduce some prices or some other things, right? And we've talked about this thing where new home builders don't ever have just like a bunch of houses sitting around that flood the market at some point, right?
Correct.
Why is that?
Because that's not profitable. Okay.
Oh, okay.
So new home builders, they sell homes faster than they build them. And what I mean by that is that generally speaking, they will sell the home when it's just a dirt lot. You put down your deposit, and then as they build the house, you go in and you pay for your flooring and whatever other bells and whistles you want and that sort of thing. So they tend to sell homes before they ever break ground. They do build what are called spec homes, which means that they're building a home that they do not have that has not been purchased yet. And under those circumstances, they will go ahead and choose their own finishes, and that's fine. And then they will sell that home usually before it's completed. Okay,
here's the next quote. However, the fact that mortgage rate shock has regained bite just as the housing market entered into the seasonally softer fall window, has translated into many home builders once again rolling out juicier incentives. So they do this all the time. Now, the conventional wisdom, and if I had to ask you guys out there, how do you think this affects the profit of these in the last few years where interest rates, especially the last year, where interest rates were pretty substantial? Do you think this really, is killing the new home builders? Like, are they losing money? Because when, the comments, we have the group of people that come in, the housing market hypochondriacs, I like to call them, the doomers, crash bros, that everything's bad. Like, a car is going to crash at the Grand Prix in Vegas, and then the housing market will get caught in that crash, right? So at the Formula One race. So anyway, home builders have substantial profit built in, right?
Right.
To their thing. So these incentives are not necessarily they're losing money.
No, not at all. It is cutting into their profit, make no mistake about that, but they're
Okay.
not losing money. So depending on the market, they might have anywhere between 10, 15, 30% that their homes are priced, the difference between their home and a resale home. So there is quite a bit of profit margin in there.
Okay. So here's the specific numbers for the 4.25% deal. Okay. Look no further than Lennar. They're here in Vegas. A home builder ranked number 119 on the Fortune 500. They're one of the largest in the U.S., though, okay, which is presently promoting a fixed mortgage rate of 4.25% in Colorado. Okay, these are the terms. Buyers have to sign a purchase agreement on a select move-in ready home. Okay, you can't go pick a dirt lot and build it out. You got to be a specific home ready to go. Okay, between the September 18th and September 25th. They have to close by the end of October. That's quite the mortgage rate buy down, considering on Tuesday the average 30-year fixed mortgage rate sat at 7.30%. Okay, so you're getting a 3%. 3%'s better.
Right.
Okay, so let's talk about a couple things in here, first of all. Obviously, these homes are ready to go and they're just trying to move them. Why do they want the cash back? Like, why do they need to move the house? What's going on?
So, pure and simple, they're trying to make their end of year numbers work.
Okay.
And they probably are trying to move specific homes. So let me give you an example. So let's say that they have 15 homes in a community.
Okay.
But maybe only 5 of those homes have the 4.25% mortgage. The other 10 do not.
Okay.
And it's the 5 that maybe don't have the best lot. Maybe it's not the most popular floor plan. They're trying to move homes that are harder to move, right? And this makes a lot of sense. It doesn't mean that every home that they have, even in standing inventory, is gonna be at this rate, right? This is a kind of blue light special.
It's a select moving. And you may get there and go, oh, I really like this community. This is great. Their views of the mountains. And then you see the 3 houses or 4 houses and you go, oh, these are like terrible lots. They face east. They don't face west toward the mountains. They go, hey, we have some lots with mountain views. And we can get you those we'll do a 6%, financing on those. But, right?
Right. So that's what they're most likely going to do. So let's say, back to my example with 15 homes in a community, maybe 5 of them are at 4.25%. Because, like I said, maybe they've got not the best lot, or maybe it's not a floor plan that was very popular, and they're kind of getting stuck with it. So something like that. And then maybe they've got another 5 homes that the lot is really small, but it's a better floor plan. So to Todd's point, maybe those are the 5.5%, and maybe the last 5 are maybe they're a bad lot but a great house, or some combination thereof. Okay. And maybe those are at maybe 6.5%. So they'll do something like that. But what they're drawing people in with, right? That honey that they're drawing people in with is that 4.25%. And then once people get there, they'll pick out a house that they really like on a lot that really works for them, and then whatever that financing turns out to be, there you go.
Okay, so obviously this initially sounds like, oh my gosh, these guys are taking a bath financially. They're getting crushed. They're having to basically give they're going to lose money on the loan. They're going to lose money on the house. The whole thing's a mess, right? Okay, so let's now show you this very cool chart. Publicly traded home builders continue to post strong earnings. Now, this chart is a bar chart, and you can see the different colors are all the major U.S. home builders. Toll Brothers is a big one, Heritage Homes, Lennar, Taylor Morrison, Pulte, D.R. Horton, KB Home are probably the biggest ones on the West Coast. And then you can see the size of the bar is their earnings, which is net income, it's profit. What's interesting about this, if you go all the way to the right, you have the last 2 are first quarter of 2023, which remember was a weak quarter, and then second quarter of 2023. Now, look how much better these builders are doing than pre-pandemic. Look at 2019 and 18 and 17 and 16 and 15. They are absolutely crushing it. D.R. Horton made more profit pretty much in the second quarter than the entire industry did pretty much all of 2014 to 2017. Just one builder made more profit in probably what's what a lot of people consider a terrible housing market. The numbers speak for themselves. These builders are making a killing, right? Okay, now I'm going to leave the chart up so you guys can peruse it. While we talk about this, why the hell would they do this? Okay, you're a builder, you're Lennar, and you've probably got a ton of money in the bank. Now that money that's in the bank is not actually, quote unquote, in a bank account. What do you think they do with that money?
Well, they probably invested. They probably put it in all kinds of investment vehicles, anything from money markets to bonds to whatever.
Okay, there are some money markets. There's a Fidelity one. There's a couple other ones, government bond funds. They right now paying anywhere from 4.5% to 5.2%, right? On their money. So what's the difference between them doing that versus them just using the money to get 4.5% on a house that they just sold? So instead of investing that money and saying, here's the money to get 4.7% in a Fidelity money market, risk-free, they're just doing it in a house at 4.25%.
Right. That makes sense too. I mean, look, it's still an investment. They're still getting the same interest. The risk is pretty limited. And remember that at the end of the day, when rates change, they'll be able to go ahead and sell these loans and recoup their cash, plus people tend to refinance or move and sell the property. So they will recoup their money before too long. It's not like their money's going to be tied up for 30 years. That's highly unlikely.
They could actually almost immediately sell it if they discount the total amount. So if it's a $650,000 loan at 4.25%, they could go to somebody and say, hey, if you'll give me $600,000, you can buy this note for $650 at 4.25%. Somebody go, okay, I'll take it because I got something, over par value or whatever, right?
Sure.
So they have ways to do this, and they also may have done this in conjunction with the lender. We don't know. What we're saying is, just because you borrow money at 7.3%, like when the rates I was quoted recently, when rates were above 7, were low 6s because that was for a VA, and there's special VA programs for veterans. One of the loans was a 15-year, and it was in the high 5. It was like 5.75%, but it was a 15-year fix. So there are other loan programs other than just whatever you see as the 30-year Freddie, Fannie, conventional type thing that are quoted. Actually, those rates that are quoted are literally the highest rates out there. So when you see that they say 7.3 whatever percent, and then people will go, but Todd, I'm a 800 something FICO score and I'm putting 20% down or whatever. That's great, but you're still getting, if you're getting the Fannie Freddie conventional, it's the worst, highest interest rate possible loans out there pretty much, right? Even with good credit score.
Right. I mean, there's certainly better rates out there depending on the product.
Yeah. And then it was funny, somebody was telling about the 10% down one that they did. And it's like, okay, you got to put more down probably to get a better deal. Okay. Here's a quote from the article. In normal times, we'll have a 10 to 15% premium over resale prices in that zip code. It's that localized. When the market was running prior to Fed rates going up and mortgage rates going up, in some locations, our premium got as high as 30% over resales in certain areas. So then you're out of whack with your biggest competition, which is resale. You can do it as long as it works, but once the market starts to normalize, you have to come down. Over time, it tends to revert to the means, which is a 10 to 15% premium over resale. So at times they charge more than 10 to 15%, but eventually they end up with this, that's what they're saying, revert to the means is they are basically going to get 10 to 15% more than a resale home. Now, this is interesting that when we talk about these numbers, home sales and everything, and prices and everything, new homes generally are not included in this. It's just the resale market. Why is that?
New homes, we have different different database for. And new homes are sort of included in what we're doing for those that are in the MLS. But generally speaking, the MLS properties are the ones that are standing inventory. They're not the ones that are in pre-sale. Not only that, but builders will put a single home in the MLS of that floor plan and then use that to sell all their other homes of that floor plan. So that they're not going to put 50 homes in the MLS. They're going to put 5 homes in the MLS, one of each floor plan. And then that's how you come in, and then they walk you through all 50 homes.
Most of these, all these numbers you see, Redfin, CoreLogic, everybody, they're all grabbing MLS data. Nobody's actually going to the new home subdivisions and saying, okay, we're going to add in your home price to whatever. It's pretty much, it has to go through an MLS, and then they grab the numbers. And then their logic is, well, it's not maybe as, it could be, in some markets, new home sales are 20 to 30% of the whole market. In some, they're a couple percent, right? An established area like San Diego or San Francisco probably doesn't have a lot of new home sales unless you go really far out to like Oceanside or way out on the peninsula. Maybe in the Bay Area, they might still have some putting up new construction.
Right.
If you're in Vegas, Phoenix, and other markets, probably parts of Florida, Texas, in the South, Arizona, and maybe parts of Utah, they're probably still building quite a bit, and you probably still have new construction, right?
Right, but I mean, I'm not sure about the other place, but in Vegas, there is new construction, just not that much of it.
The other thing, too, is when they say, hey, the numbers of sales are down 30%, that doesn't necessarily include, because sometimes when the resales are down, there's more new homes being built because there's not enough inventory.
Right.
So the actual total number of homes is actually higher. Now, but we do know this. The new home companies are being very conservative with building. They're not really, is it that they're intentionally under matching demand so they can keep charging a little, like they don't want to overbuild?
No, they don't want to overbuild because they don't want to cannibalize their own market. That's already happened to them. They don't want to do it again. And then we've talked about this before. They have other constraints. Of course, they've got regulatory constraints. There's land, there's labor, there's material. So there are other constraints. So they want to make sure that they are keeping a tight control over the pricing so that they are maximizing profits. And they're also keeping a tight control because, like I said, there are other constraints that could cause them to get into trouble if they overextend. Yeah,
Vegas is a good example of that. The economic numbers for Vegas came out just recently. We are outperforming we're one of the top 10 cities in the nation for job growth. And obviously we have a ton of people moving here, 80,000 a year. We're outperforming the rest of the nation. Even though we have a relatively high unemployment rate, it's misleading because the two largest sectors with high unemployment historically that have high unemployment because of turnover are hospitality, leisure, and construction. Guess what the two largest industries in Las Vegas are?
Hospitality and leisure.
Hospitality, leisure is called one, and construction.
Right.
They're the two largest. In a normal market, those two have 12 to 15% unemployment. Because just because you're a construction worker doesn't mean that you work every day and then when your job ends, the next day you go work on the next project. Sometimes you have 2 weeks, 3 weeks off and then you don't start that next project. So you're technically unemployed for that period until you start. Same thing with hospitality workers. You work and then your temp job ends because you were working a specific, like people that work the conferences. Okay, there's a conference this week, we'll work this week, and then I don't work until the next conference, which is a week from now, and then that's a 2-week conference or whatever, and then you just sort of roll through that. But the bottom line is those numbers are tightening up because there's so much growth in Las Vegas. So in a market like Vegas, we need to build like crazy with 80,000 people coming here. We probably need to build 10 or 20,000 houses a year. I don't think we're building that because we certainly aren't. So that's one of the reasons why people go into the resale market because there's just not enough new homes, right?
Correct.
So what's the answer for this whole thing? Like, we're not going to do anything with rates because rates are basically going to stay the same, probably won't drop for a year, right? So this is a new thing. But we've been at these rates for a year. We've been at, the first time rates broke 7% was October. That was 11 months ago. And home prices have gone up nationwide and in Vegas. So clearly 7% rates is not the magic number that's going to cause homes to crash. And honestly, Juana, the people getting the people that are saying, oh, I'm just going to buy a home at 7% and put 3% down, none of those offers are getting accepted.
No, I mean, it really doesn't make sense. There are plenty of buyers out there that are well qualified, are putting more money down, and they're going to have a lot less drama through the transaction. So those offers tend to be accepted versus offers that are a little more speculative.
This is like when Boeing says, oh, our new 737 MAX aircraft, it's a $60 million airplane. That's the price for it, right? But if United orders 300 of them, they get them for $24 million each, right? They don't pay what you would say is like sticker price or whatever, right? They get a substantial discount.
Okay, it's like buying toilet paper at Costco.
Exactly. Right. We just connected the dots where we went from the housing market to toilet paper at Costco.
That's right.
Which the reason they're the same is 2 years ago, you could not get toilet paper at Costco. You had to buy it on the black market because Costco was completely out of toilet paper.
And you also couldn't get a house because nobody was doing business.
The funniest thing ever was walking through Costco with the masks on and people coming up to us going, oh my God, we watch your show. And Juan is saying, how the hell do you even know who we are with these ridiculous masks on?
That was pretty fun.
That was pretty fun.
Except for the mask part. That wasn't so much
Except
fun.
for the mask part. That wasn't very fun. Okay,
All
Juana.
right.
So let's wrap this up. New homes, resale homes. To me, it looks like we're in this status quo. We've been in it for a year. Price is moderated. They're probably going to moderate for another year. We don't really know what's going to happen with the economy. Slowing in the economy, certainly in a city like Vegas, a national recession wouldn't affect us very much. Best thing that can come out of a recession is interest rates to drop, right?
Right. But I don't think interest rates are going to drop. So we'll kind of go there.
Okay.
I mean, do I think that they're going to go down quarter point, half a point sometime next year? Okay, fine. But that doesn't move the needle for somebody who's comparing it to the 4.25. So
why are home prices not tanking? Like they were supposed to be down 40 or 50% and they're actually up. So why didn't that happen? Literally been hearing about this now for 4 years.
Okay, so I think they're actually going to continue to go up, not because I'm a housing cheerleader, but because people have been hunkered down for a year at this point, not doing a transaction, waiting for interest rates to come down. And, like with anything else, we all have a limited amount of patience.
Right.
And if you're living in a situation where you're on top of each other and you've just kind of had enough, you're going to reach that breaking point. You're going to say, I don't care what interest rates are. We're just going to do this because I can't do this anymore. I need some space, or, I need to move closer to this, or whatever it is that you need to do. So I think we're going to hit probably the end of this year, beginning of next year. People are just going to say, forget it. I'm going to go ahead and jump. And I think you'll see that. And I think you might even see some sellers who are like, you know what, I'm over this. We just need to go. Mm-hmm. So I think that's what you're going to see. I think you will see prices go up more. I think you might see a few more transactions than what we've seen, because I think people are just going to run out of patience and just want to get on with their lives. Kind of like we did with the pandemic. At some point, we all just kind of threw our hands up and said, you know what, I don't care anymore. I need to get on with my life. Okay.
I mean, I kind of agree. I mean, we said, I think we said 2 years ago, for sure, nobody knows what's going to happen in the future. Nobody knows what's going to happen in home prices. Most of the predictions were higher than what we predicted. Remember, everyone else was predicting 18. We were predicting 12, and it ended up going up like 15, something like split the difference.
Yeah. Well, yeah. But, that's neither here nor there. I mean, look, the bottom line is we have a lot of pent-up demand, and that has not been met. And at some point, the dam's going to break, and people are going to start selling houses, buy houses. They're just going to get on with their lives.
I believe that there is enough, that this pent-up demand is on both sides, pent-up sellers, pent-up buyers.
Right, yes.
And then as the houses come on the market, there will be people to buy them. Mm-hmm. Just read an article where the largest single purchaser of homes, which are all these big hedge funds, mm-hmm. have stopped purchasing homes even though they have the cash, because they're running out of homes to purchase.
Right.
They literally don't have enough inventory to purchase.
Right, because remember, they have very specific criteria as to what they're looking for. So, just having 4 walls and a roof is not sufficient. They have very specific criteria as far as where they're purchasing, what the home has to be like, and as far as what's happening in that community with the growth and that sort of thing. So because of their very specific criteria, there are not enough homes that meet that criteria for them.
Yep.
All right, so what do you think? Did you make it to the end of the video? Where are you watching from? What's going on where you're watching? And what do you think about Lennar's 4.25% loan? Have you seen any other home builders or anybody else offering some amazing deals? Tell us about it in the comments. We'd love to hear about it. Please remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.